Hi, Doug Andrew here. In this episode, we're going to dive deep into how universal life can be designed for living benefits. What does it mean to maximum fund an indexed universal life insurance policy, to use it for living tax-free income or for your business, not just so much the death benefit, which most people relate when they think of life insurance. We're going to go through how this was really a buy term, invest the difference, couched under a tax-free umbrella, because I was a big buy term, invest the difference proponent when I started in 1974, clear up until 1980, when E.F. Hutton, the brainchild behind Universal Life, first introduced it. We're going to talk about how to take the least amount of insurance you can get away with and put in the most money the IRS allows, how this all started, and then what happened when the IRS challenged E.F. Hutton back in 1980. And in subsequent episodes, we're going to talk about the tax citations that were passed and how you have to jump through these hoops in order to make sure that you have structured it correctly. Because the biggest problem I see in the insurance industry is most insurance agents do not know how to structure it properly and fund it correctly so it performs as a tremendous, great internal rate of return, tax-free cash cow. So at the end of this, you're going to understand what the guideline single premium is, what the guideline annual or guideline level premium is, and I'm going to give you an example of how people, when I started in 1980 selling Universal Life, had 10% payouts during that high interest environment. So let's start out with how do we maximum fund a Universal Life policy? Because indexed Universal Life didn't start until 1997. One of the very first companies that I represented was ING, which is now Voya, and they introduced it in 1997, a year after they introduced indexed annuities. Now, what you're doing is you're putting in the most premium into an indexed universal life if you're using it for living benefits that the IRS allows. And you're going to put that premium in as fast as they allow. But back in 1980, Hutton just went, why are we trying to help our clients with their money in stocks, okay? Because they were a brokerage firm. And they had money diversified in stock portfolios and mutual funds and what have you. My brother-in-law was a manager of E.F. Hutton management office in Provo, Utah. And so what they were doing is helping their clients try to earn rates of return averaging, let's say, 12%. I had a Series 1 securities license back in 1974 until 1980. In fact, by 1980, I ended up with over 3,000 clients in 13 Western states. And to be honest with you, I was a big buy term, invest the difference proponent. I went to universities and debated against whole life agents. And I showed that if you were to buy term insurance and you really did invest the difference, the biggest problem is a lot of people would not have a disciplined system. They'd buy term intending to invest the difference. And then what did they do? They spent the money. And so it was actually maybe better if they were forced to set aside money at a nominal rate of return of 2.5%, 3.5%, which is what whole life insurance generally paid back then. But see, if you had a disciplined system, from 1974 to 1980, had a product that was a unique franchised product that had a term to 65 insurance policy, but it had an annuity rider. And that annuity rider would pay the person, if they were conservative, between 7.5% to 8.5% interest. Now, you don't see annuities doing that these days, but that was a high interest environment back in 1980. Mortgages on homes were 12 to 18%, even 21%. Banks were paying on CDs over 10% interest. And so the insurance companies were earning on their general account portfolios, okay, on the AAA and AA bonds. The mortgages they had on skyscrapers and shopping malls were up in the 12% range, and so they were earning those rates of return. See, interest rates are relative. What I mean by that is when interest rates are high for earning, they're high for borrowing. When they're low for earning, they're low for borrowing. Interest rates are relative. They're just It doesn't matter if you're on the paying or receiving end, interest rates are relative. So what happened back then in that high interest environment, insurance companies were earning on their invested assets average returns in the teens, 10, 11, 12, 13% on mortgages and bonds and so forth. This is the environment universal life was first conceived and developed and designed by E.F. Hutton. And all they did is said, you know what, if we try to invest people's money in the market, the stock market is like a person with a yo-yo, hopefully walking upstairs. But there are periods of time where the person is not walking upstairs, they're walking across a flat surface. Like the decade from 2000 to 2010, that person with a yo-yo was walking across a flat surface. They made money, lost money, made money, lost money. At the end of 10 years, the Dow Jones, the S&P 500, the Russell 2000 was basically where it was 10 years earlier. But with indexed universal life, you're going to learn that our clients doubled and tripled their money during that period. People who had their money in the market, it's called the lost decade, because they made money, lost it, made it, lost it, and they were right where they were 10 years earlier if they had their money in the market. We're going back to 1980, and I had my clients, I was trying to help them earn an average return of 12%. Some years, they earned over 20%. Did you ever play red light, green light when you were a kid? What would happen is you would take a few steps forward and then a few steps back, forward and back. And so what we were trying to do is take an average 12 positive steps forward. So that would be a 12% rate of return. Now that's pretty good today. No, most people are not earning that. Most people today, if you buy and hold, Dalbar, who studies investor behavior, said if people would buy and hold, they would probably earn 9.14% before tax. After tax, maybe netting 6% if they just kept their money in the market through the ups and downs. Most people don't do that. Most people, they get scared when the market starts going down, and they finally sell when the market drops 25, 30, 35%. They say enough already. And then they wait until the market comes back up again before they buy back in. And so they are selling low and buying high, and that's why Dalbar says the average investor return is only about 3.5%. If they bought and held, they would earn 9 and net 6 after tax. So there's a huge difference between investment return versus actual investor return. We were trying to average 12%, so let's just use that for an example. That meant that if I had somebody with $1 million, to keep it simple, 12% is 120 grand a year. So you ought to be able to pull out 120 grand of income without depleting your principal. But E.F. Hutton realized if you pull out 120,000, you're going to pay a third of that between federal and state tax in taxes. So you're not netting 12. You pull out 120,000, you pay 40,000 in taxes, you're only netting 80,000 or 8%. You have another 1% in fees because most asset managers charge at least 1% in fees. So you're taking 12 steps forward, 4 steps back in tax, another step back in fees, and you're only netting 7. You're earning 12 to net 7. E.F. Hutton said, what are we thinking? Why don't we go over to a safer, more stable insurance company, and let's take 11 steps forward and only 1 step back because it's tax-free. We don't have to pay tax, and we can have more stable, predictable income. So back then, from 1980 until 1990, on my universal life insurance policies, I never got credited less than 11.75%. Some years as high as 15.5%. Let's just take it down to 11. I'm taking 11 steps forward. I'm earning 11, but I'm taking 1 step back. That's not tax. That's the cost of the insurance, the COI, that the IRS said had to be there, or it would not be deemed a tax-free insurance policy. It would move over to another section of the Internal Revenue Code, and it would be taxable. And so this is sort of the environment E.F. Hutton designed and came up with this idea. And they said, if we're going after income, let's sort of self-insure. Let's throw in $500,000 Now, you don't have to put in $500,000, but I had many clients who did. I'm going to use that as an example. There's nothing magic about $500,000, but you put in $500,000, if you're self-insuring, then what you're doing is you're paying $500,000 for $500,000 of insurance. People say, well, who would do that? Well, if you're doing it for the living benefit, you're putting in $500,000, and if you die, you leave behind the $500,000. You just self-insured yourself, so there is no risk. But if you call it an insurance policy because it's structured under the guidelines of the Internal Revenue Code in 3 sections you're going to learn about, it's tax-free. And E.F. Hutton said, it's tax-free. So they designed their policies to put in a whole bunch of premium with hardly any death benefit or any amount at risk because you're self-insuring, and it turns into this tax-free cash cow. And I saw it right off the bat because I was a big buy term, invest the difference proponent. And I go, huh, this is brilliant. This is buy term, invest the difference, tax-free. You wouldn't believe how many insurance agents to this day still do not understand that is how it was designed in the first place, for living benefits. So let's go through and talk about how we do this. Back in 1980, I had clients that would throw in, let's say, $500,000. So if they put in $500,000 and the amount of insurance was $510,000, then the only amount really at risk is $10,000 because $500,000 of it is your own money. But if you're doing it for living benefits instead of death benefits, you throw in 500 grand, and back then, if you earned 11 and netted 10, 10% on $500,000 is 50 grand. So $50,000, okay, of tax-free income. I had clients throw $500,000 into the very first universal life insurance policies, and they hit the ground running, pulling out $50,000 a year of tax-free income, and they've been doing it ever since. It was incredible because people wanted the safety, the stability, the predictability of earning a 10% payout on the money they put into the universal life policy. And if they died, they left behind $500,000, $510,000. But see, sometimes people said, who would ever pay $500,000 into a $500,000 life insurance policy? And E.F. Hutton would go, our clients do. Why? Because they're doing it for the highest rate of return for living benefits under this tax-free umbrella. They're not doing it to get the most insurance. I mean, with 500 grand, I could buy 5-10 million of life insurance. That's not the objective. The objective is to have the highest rate of return to give you tax-free income, so you sort of self-insure. Now, this is brilliant, but to this day, many insurance agents do not understand this concept. So I want you to understand, you're taking the least amount of insurance the IRS will let you get away with. The difference between what you're putting in and the actual amount at risk that you are paying for the insurance, the cost of insurance. You're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most money the IRS will allow, as fast as they allow. But in 1980, there were no restrictions for that. It was so new that we had clients do this for a couple of years before the IRS came to Hutton and said, what are you doing? They said, we're not doing anything wrong. They went to court. E.F. Hutton won. They weren't doing anything wrong. But then the IRS said that we have to change the definition of tax-free under these 3 sections of the code that have been grandfathered since the Internal Revenue Code, which started in, 1913, over a century. It's like the sacred cow. So when we talk about it, you're going to learn how these tax citations came about in the next few episodes in 1982, 1984, and 1988. But at the very beginning, I could throw in a huge lump sum of $500,000 and start taking this tax-free income instantly. It was unbelievable. It was like a tax-free annuity, but it was better than an annuity. But what you have to understand is you're doing this in order to get predictable rates of return. The secret is that life insurance and the Internal Revenue Code is the only financial instrument that allows you to accumulate your money tax-free, then access your money tax-free, even before you die. And when you do die, it blossoms, it increases in value, maybe just by a little bit, and transfers income tax-free to your heirs. Nothing else in the Internal Revenue Code does that, but they had to pass some tax citations that you had to jump through what I call hoops in order to do that as the 1980s progressed with this new product called Universal Life. Now, when we talk about the amount that you're desiring to put in, we will call that the guideline single premium. This is very important to understand. It's called the GSP. Now, you will see this at the back of almost every NAIC, that's the National Association of Insurance Commissioners, required illustration that you print out for your client, your prospect. It's usually on the last page, and you will see the coding, and it will say usually GSP. That stands for the Guideline Single Premium. That is the amount that you're allowed to put into the policy in the first 11 years. You can't put in more than that. If you put in more than the GSP, the insurance company must refund it to you. They will refund it to the client because you violated the definition of an insurance policy. It is no longer an insurance policy. It's no longer tax-free. So you have to abide by the GSP. That's the most you can put in during the first 11 years. Now, when Universal Life first came out, you could pay that all in one fell swoop. So if you have a GSP of $500,000, you could put it all in the very first day of the first year. They changed those rules a few years later, but that's the most you could put in the first 11 years. After that, you can basically put in 1/11 of that. So let's say it's around $45,000. You could put in $45,000 a year starting the 12th year, the rest of your life if you wanted to. Or you can open up another Universal Life policy and maximum fund that and get some additional insurance coming along for the ride if you want. But that's what the GSP is. Now, some people say, well, why don't you just have a GSP of $10 billion? Well, because then you're taking out more insurance than you need, and the cost of the insurance is way more than what you want. You want to have the least amount of insurance you can get away with based upon how much money you want to reposition. So this is where this GSP comes into play. If I was meeting with a client, you're going to learn in this series that I would sit down and look at their repositionable assets, assets that were non-performing. Maybe they had $100,000 of money in a CD at a bank earning 1%. Pretty pathetic. And maybe they had $200,000 sitting in their IRAs or 401ks in the market, and they've been losing money, and they can't sleep at night. Maybe they sold a piece of real estate or a duplex or something, and they have $200,000 of real estate equity they got out of a project, and they don't know what to do with it. So they have $200,000 coming from the sale of a piece of real estate. They have $200,000 they're getting out of their IRAs or 401ks, and they're not ready to retire yet. They have $100,000 sitting in some bank or a credit union earning a measly 1%, and they want to get a better rate of return and increase the safety. The total of that, 200 plus 200 plus 100, would be $500,000. If they want to be grandfathered to be able to put in up to $500,000, they're not obligated to put in that much. That's the most they can put in. That is called the GSP. You must define that. This is what I call the backdoor approach. Most people came to me not necessarily needing or wanting life insurance. They loved it when they got it, but they came to me because they wanted the best rate of return. They wanted liquidity. They wanted more safety. They wanted greater rates of return, not subject to market volatility. They wanted tax advantages. And I go, okay, well, what assets are not performing? And we would identify the ones that they wanted to get it out of here, here, here. And then we would come up with the amounts based upon lump sums that they had on hand. Maybe impending lump sums, an inheritance or the sale of a property in a year or two. And any money that they wanted to set aside on a regular periodic basis, like monthly or annually, just like saving in an IRA or 401k, only here is far better, as you're going to learn. I would add up all of that, and if they're going to put in $10,000 a year, you go $10,000 a year times 11 years, that's $110,000. That goes into the computation of the GSP. You add up all these assets when they're accumulated over the first 11 years, or maybe they're not going to fund it for 11 years. If it's 5 years, what amount of money are you going to want to grandfather yourself to put into this insurance policy? Now, I actually call these insurance policies buckets. It's like a bucket designed to accommodate money. How much money do you want to be grandfathered to be allowed to put in here? So let's say it's $500,000. You don't have to put that much in. It would behoove you to. Because if you put in $500,000, it turns into this cash cow that's tax-free sooner than later. And you can start taking out income. So that's what the GSP was. It was the amount of money you wanted to be able to put in there. And you can't put in any more than that the first 11 years. If you wanted to add more money, you had to wait till the 12th year, and then you were allowed to put in maybe 1/11 of that, about $45,000 a year, each year the rest of your life, if you wanted to. But that's the guideline single premium. What I just told you, the 1/11 of that, that's called the guideline level or guideline annual premium. So when we talk about GSP, that's the guideline single. When we talk about the guideline annual premium, that means this amount divided by about 11. It's not an exact science, but it's generally 1/11 of this is the guideline annual. Sometimes this is referred to as the guideline level premium on the back page of an illustration. So that would be $45,000. You're going to learn about a TAMRA 7-pay premium in a few episodes from here. But the GSP is the amount that you want to put in during your lifetime, or at least the first 11 years. And you can put in 1/11 every year after that. That's the guideline annual or guideline level. When we start talking about complying with the TAMRA citation of 1988, you're going to learn that this is usually 1/5 of that number if it's universal life. It's 1/7 of that if it's whole life. Don't worry about that yet, but you'll understand it's all based upon how much money do you want to be grandfathered to be allowed to put into that without being obligated to do it, but it would behoove you to put that in. You don't want to create a bucket bigger than you're likely to fill up with money. And then it's just going to compound and grow tax-free like crazy. And so it's a science to design these correctly. What we're after here is the best internal rate of return so that the cost of the insurance, I usually have this like a spigot on the bucket, the COI. The cost of insurance, you want this draining out the least amount of cost as possible. So that, like I shared, if I earn 11%, I'm netting 10. Only one of the percentage points is paying for the insurance that the IRS says has to be there, or it moves from the tax-free life insurance part of the code over to the taxable investment part of the code. Oh, that's an investment. If you violate this, you no longer have the tax-free umbrella. You no longer have the protection of tax-free insurance. You now have moved over to taxable investments, taxable sooner or later. And you usually are subject to market volatility. So when we talk about this, I want you to remember you're designing the insurance contract to accommodate the amount of money, the most money you want to be able to put in there, and you take the least amount of insurance the IRS will let you get away with, so that your objective is to earn 11 and net 10. If you earn 9, you net 8. If you earn 7, you net 6. But some years, if you earn 25, you net 24, like many of my clients, and I have. So this is a science that will allow you to be able to create vehicles that can give your clients an internal rate of return within 1% of the gross rate of return, and that is far less than the taxes people pay. They would have to earn 15%, and in a tax-deferred IRA or 401k, in order to net 10. I only have to earn 11 and net 10 in a universal life. And so the insurance, the COI, is being paid for with a minuscule portion of interest that would otherwise go out the window in taxes. And I'd have to earn 15 to net the same 10 in an IRA or 401k in the market. That's too risky to try to do that. That's the beauty behind a max-funded indexed universal life policy. So you design it for living benefits for people who are using this for retirement income or college funding or emergencies or real estate management or working capital for business. And we're going to go through a lot of these examples as we continue in this series. You're going to be blown away with how this is universally applicable. It's the dream solution for so many different goals and objectives. It's what I use for all kinds of goals for money that I want at my fingertips with an electronic funds transfer or a phone call. It's that liquid. I want liquidity, I want safety, I want predictable rates of return, and I like tax-free. You're going to learn this is what spells the laser test.